So now I am discussing third module, income from other sources. So chargeability. An income is chargeable under this head if the following conditions are satisfied. What are the conditions to be satisfied? The income must not be an exempted income. The income must not be chargeable under any other head of income. If the following two conditions are satisfied, an income is chargeable under this head, income from other sources. Incomes are chargeable under this head based on what system of maintaining the books of accounts. For example, under mercantile system, the income are taxable on accrual basis. On the other hand, if the books of accounts are maintained under cash system, the incomes are taxable on receipt basis. So these are the two systems are maintaining. Next, what is the format for computing taxable income from other sources? The first income is dividend, interest on security, bank interest on fixed deposits, casual income, income from family pension, composite rent, income from subletting, rental income from machinery, plant or furniture, gifts, insurance commission, deemed incomes, mining rent, fully taxable, royalty, fully taxable, ground rent, fully taxable, withdrawal from national savings scheme, agriculture income from a place outside India, even director fees or commission, salary received by a member of parliament or MLA or MLC, daily allowance received by MP, MLA, each exempt. So rent from land or ground rent, even examination fees received by a teacher, not from the employer, that is also fully taxable. Remuneration received for writing short stories or poems, any honorarium for checking answer books, and last one, any other incomes, even advance money received and forfeited during the previous year 14-15. So less exemption under section 57. What exemptions? Any expenditure incurred only or for the purpose of earning the income is deductible. So provided such expenditure is neither of capital nature nor of personal nature. Finally, we get taxable income from other sources. So the following important note: income from each source income from each source can be computed separately. Honorarium for giving lectures at seminar is taxable under the head income from profession. Any expenses incurred to earn tax-free incomes is not deductible under alternative tax regime. Allowance MP, MLA and standard deduction of family pension is blacked. So let us we discuss one by one. So the first item is dividend. Dividend from an Indian company is taxable if it is received on or after 1 4 2020. The rate of TDS is 10% on dividend income paid in excess of rupees 5,000 from a company or mutual fund. This rate will be increased to 20% in the absence upon submission by the recipient of dividend income. Interest on loan taken for purchase of share is deductible, but it is limited to 20% of gross dividend income received. However, other expenses incurred to earn dividend are not allowed. Net dividends from a foreign company are taxable in the hands of shareholder if assessee claims double taxation relief. The gross dividend shall be taxable. Even deemed dividends from an Indian company are also taxable. So, dividends from cooperative society are also fully taxable. What is the second point? Interest on security. While computing income from securities, the following points must be taken into account. So, what are the types of security? Securities may be classified into two types: less tax security, tax free securities. Less tax securities may be classified into two types: government securities, so commercial securities. In government securities, no TDS. But in commercial securities, again classified into two types. One is listed and unlisted. So, listed and unlisted. Listed TDS will be paid. Unlisted also TDS will be deducted. The second type is tax free securities. Tax free securities are also classified into two types. One is government security and 100% exempt from tax. Commercial securities are classified into two types: listed and unlisted. TDS will be there. So, securities like less tax or tax free may be issued by the government or statutory bodies or local authorities. Less tax securities implies that tax should be deducted at source and the net amount should be paid to the security holder. On the other hand, tax free security implies that no tax has been deducted at source. The security holder will be paid gross interest. The important fact to be noted at this point is that only government has the right to issue tax-free securities. If company issues tax-free securities, it will have to pay income tax to the government on the amount of gross interest paid to the security holder. The amount of income tax paid by the company is deemed to be income of the assessee. Therefore, it should be always grassed up. So, this is the rules for grassing up of interest. It is gross interest which will be included in the total income of the assessee. If interest is paid to the assessee after TDS, such interest should be grossed up because the amount of TDS is considered to be part of the income of the assessee. The following points can be considered in this connection. What are the points? The first point, in case of less tax government security is not deducted at source, therefore interest from such securities should not be grossed up. In case less tax commercial securities, if the amount of interest is given in the problem, such interest shall be assumed to be net interest. Therefore, such interest should be grossed up. On the other hand, if the amount of investment and rate of interest is given in the problem, gross interest can be calculated straightway. In case of tax-free commercial securities, the interest should be always grossed up, irrespective of the fact whether the interest or amount of investment and rate of interest is given in the problem. So, what is the formula for grossing up of interest? So, gross interest is equal to net interest into 100 divided by 100 minus tax rates. Note, for tax rates refers to rates of TDS table. So these are the interest on the following securities is 100% exempt from tax. What are those? National Defense Gold Bonds 1980, National Plant Certificates 10 years, National Plant Savings Certificates, 12 years National Savings Annuity Certificates, Treasury Savings Deposit Certificates, Fixed Deposit Schemes governed by the Government Savings Certificates, Fixed Deposits, Rules 1968, Post Office Cash Certificates 5 years, Post Office National Savings Certificate, Post Office Savings Bank account to the extent of rupees 3,500 in case of individuals, rupees 7,000 in case of joint accounts. So, Post Office Cumulative Time Deposit account, even public account in Post Office up to 5,000. Fixed deposit schemes governed by the Post Office Fixed Deposit 1968. Deposits made by a retired government employee out of his retirement benefits for the lock-in period of 3 years. Special Bearer Bonds 1991. Special Deposit Schemes 1981. Capital Investment Bonds, Relief Bonds, NRI bonds issued by RBI, non-resident rupee deposit schemes, interest on tax-free government security, and interest on gold monetization scheme. The next reading, no TDS is made for the following securities. Interest on less tax government security, no TDS. 4.1% of national defense bonds, national development bonds, 8th issue national savings certificate, debenture issued by cooperative society, 6.5% gold bonds 1977 or 7% gold bonds 1980. Interest paid to an individual account payee check for an amount not exceeding rupees 5,000 by listed companies in which public are substantially interested. Interest on foreign government securities is not grassed up as no tax is deducted at source in India on such income. Post office monthly income accounts, post office time deposit, post office recurring deposits, and last one Indira Vikasa Patra and Kisan Vikasa Patra. So, what is bond washing transaction under section 94, subsection 1? It refers to a transition which consists of selling the securities by a high income class assessee to a friend or relative who are generally low income class assessee before the due date of interest and acquiring back the same after due date of interest with an intention of evading the tax. To prevent this type of tax evasion under section 94 subsection 1 provides that where a security owner transfers the security on the eve of due date of interest and reacquires them, the interest received by the transferee will be deemed as income of the transferor, and accordingly it will be included in the total income of the transferor and not of the transferee. So, what are the deductions under section 57? The first one is commission paid to the bank, a remuneration payable to any person for realizing the interest on behalf of the assessee is deductible. If the assessee himself collect the interest, he cannot charge us for his own labor. Interest on loan borrowed for purchasing securities is fully deductible. However, interest on loan payable outside India without TDS is not deductible. The third point is bank interest on fixed deposits. It is fully taxable. The bank, cooperative society, post office should deduct TDS if the following conditions are satisfied. What is the first one? There should be a fixed deposit. The interest should be credited annually. The interest exceeds rupees 10,000. If net interest is given in the problem, it shall be grassed up. The formula for grassing up interest, grass interest is equal to net interest into 100 divided by 100 minus tax rates. The fourth one is casual income. What is casual income? It refers to income which is unexpected and unpredictable in nature. It includes income from lottery winnings, crossword puzzles, winnings, gamblings, betting, and the like. So, winnings from lottery, crossword puzzles, TV game shows, tax at source is deducted. If such winnings exceed rupees 10,000, even in case of winnings from horse race, tax is deducted at source if the amount of winnings exceeds 10,000. Further, in case of winnings from other races, gambling and betting card games, tax is not deducted at source. Even no expenditure is allowed to be deducted out of this income. If net winnings are given in the problem, it shall be grassed up. What is the formula for grassing up winnings? Gross winnings is equal to net winnings into 100 divided by 100 minus tax rate. The second note is income from maintenance of race horses is taxable under the head income from other source. If there is any loss, if stake money is less than expenses from activity of maintaining of race horses, such loss can be set off from income from the same activity and not from any other sources. What is the next point? Income from family pension. What is family pension? Family pension refers to pension received by the family members of a death or deceased employee. The tax treatment for this income is as follows. Taxable income from family pension payable by the employer or to legal heir of deceased employee shall be computed after allowing standard deduction. Such deduction is allowed either at 33.33 of family pension or maximum limit of 15,000, whichever is less. The next point is composite rent. What is composite rent? If the assessee receives composite rent from his tenant, the portion of the rent attributable to the building should be assessed as income from house property, and the remaining portion attributable to the amenities services must be assessed as income from other sources. On the other hand, if the composite rent is inseparable, then the entire rent should be assessed as income from other sources or income from business. The next one is income from subletting. Rental income from sublet portion of the house shall be assessed income from other sources. The taxable amount of such rent is to be computed as follows. So rent from sublet portion less expenditure on sublet portion, then finally we get taxable income. Next one is rental income from machinery, plant or furniture. Any rental income derived from letting out of machinery, plant or furniture without building is to be computed after making the following deductions. The amount incurred by the assessee, an account of current repairs of the assets hired out, the amount of insurance premium paid by the assessee against damages of the assets hired out, and depreciation in respect of assets. These three items are to be deducted. Next one is gifts. If aggregate amount of gifts received from non-relatives exceeds rupees 50,000 in the previous year, it is fully taxable in the hands of recipient of such gifts. This rule is however not applicable if gifts are received from a relative or at the time of marriage or by will. The term relative means, for example, assessee is X, spouse Mrs. X, brothers and sisters of assessee X, spouse Mr. X, brothers and sisters of father mother assessee of X, lineal ascendant or descendant of assessee X spouse, but not cousin and brother sister of grandfather mother of Mr. X and Mrs. X, elder brother of father in law. So, what is the money or property received on or after October 1, 2009? There are different categories. For the ceiling of 50,000, whether a single transaction would be examined or all transactions of the previous year considered. Category 1. Any sum of money, gift in cash or by check or draft, all transactions taxed if aggregate amount of some money received by an individual or HF without any consideration from one or more person during the previous year exceeds 50,000, the whole of such aggregate value will be chargeable to tax. The second one, immovable property without consideration. If any immovable property without any consideration is received and stamp duty value of which exceeds 50,000, stamp value will be chargeable to tax. Single transaction. Immovable property for a consideration which is less than the stamp duty value. If any immovable property is received for a consideration which is less than the stamp duty value of the property by an amount exceeding rupees 50,000, the differences between stamp duty value and consideration is chargeable to tax. Movable property without consideration. If aggregate fair market value of movable property received without consideration during a previous year exceeds rupees 50,000, the whole of aggregate fair market value of movable property or properties will be chargeable to tax. Movable property for a consideration which is less than fair market value. If movable property is received for a consideration which is less than the aggregate fair market value of the property by an amount exceeding rupees 50,000, then the difference between aggregate fair market value and the consideration chargeable to tax. Next one, insurance commission. If resident individuals receive insurance commission in the previous year, such commission is taxable under the head income from other sources. Further, if the amount of such commission is more than rupees 20,000, tax is deducted at source. If net insurance commission is given in the problem, it shall be grassed up. So the formula for grassing up of such insurance commission, net amount into 100 divided by 100 minus tax rates. Last one, interest on compensation or enhanced compensation. Income by way of interest received on compensation or enhanced compensation shall be assessed under the head income from other sources in the year in which it is received. However, 50% of such interest is deductible under section 57. Consequently, 50% of such interest is taxable. Actual expenses shall be ignored. So, deduction under section 57. Any expenditure incurred wholly for the purpose of earning the income is deductible provided such expenditure is neither of capital nature nor of personal nature. What is the rate of TDS? The first one is interest on security issued by statutory bodies or local bodies at 10%. listed 10%, unlisted 10%, bank interest 10%, casual income 30%, insurance commission 5%, commission on sale of lottery tickets 5%, rent of plant and machinery 2%, rent of land, buildings, furniture splitting 10%, and last one, deemed incomes. What is deemed incomes? Deemed incomes are not incomes, but as per IT Act, they are regarded as an incomes and included in the taxable income from other source or business. The following are considered to be deemed income, for example, cash credit, unexplained expenditure, unexplained investment, even unexplained money also. Other incomes mentioned in the formats from point number 12 to 23 fully taxable. Any expenditure incurred only for the purpose of earning such incomes is deductible provided such expenditure is neither of capital nature nor personal nature.